Well, our next plenary session of this marvellous conference, which is on this plenary session, is going to be on sustainability in investment management. And I'm very pleased to say that we have with us today to introduce us, our guest, Professor Susan Dodds, who is Deputy Vice Chancellor, Research and Industry Engagement. And I can't think of a better portfolio than to come and welcome you today, Maria. The Research and Industry Engagement is what this whole conference has been all about. So the other thing I would say is that it's also wonderful to see you. Everyone will remember that the conference was opened by our Vice Chancellor. Our Deputy Vice Chancellor, Research and Industry Engagement, has come along to support the conference today and welcome our special guest, Maria, at this session. And indeed, our evening session will be closed, the conference will be closed by our college provost. So it's wonderful to see the enormous support that La Trobe has given to this wonderful conference that the universities have put together. So over to you, Sue.
Thanks, Greg, and good afternoon and welcome everyone. As we begin, I'd like to acknowledge on behalf of La Trobe University that this event and our participants are located on the lands of many traditional custodians across Australia. I'm joining you from beautiful Wurundjeri country of the Kulin Nation, although it's a little bit grey outside. As a university, La Trobe recognises First Nations' ongoing connection to the land, and we value their unique contribution to the university and wider Australian society. We're committed to providing opportunities for Indigenous Australians, both as individuals and as communities, through teaching and learning, research, and through our community partnerships across all of our campuses and online. We pay our respects to Indigenous elders, past and present, and extend that respect to any Indigenous participants who are joining us online today. But welcome everyone to the Financial Markets and Corporate Governance Conference. Many of you will be joining for the third day of presentations, but some of you may have just tuned in for this online keynote address. The Financial Markets and Corporate Governance Conference first started 11 years ago when Bala Balachandran initiated a meeting of 100 academics and practitioners from 17 different countries to present and share the research papers. And it's wonderful to see that the success of that first conference continues on, and we're here today in our 11th year. And this event is part of a series which makes up the three-day conference. And as you can see, we're working online as we did last year. We've managed to find a way of bringing people from many more places to collaborate in the conference. And I'm pleased to welcome you all, introduce our guest speaker for this session. Today, we'll be hearing from Maria Wilton. He'll be giving a presentation titled Sustainability and Investment Management, Trends and Opportunities. And before she speaks, I'd like to share just a few bits of Maria with you. Maria is an experienced non-executive director and finance executive with a 30-year history in the investment and pension fund industry. She was CEO and chair of the Franklin Templeton Investments for 12 years, and prior to that held various investment and business roles in global and domestic asset management companies, including BT Financial Group, County, and JP Morgan. Before joining the investment management industry, Maria worked for the Commonwealth Treasury in economic research. And she's currently vice chair of the Global Board of Governance for the CFA Institute, Deputy Chair of Infrastructure Victoria, and a Director of Victorian Funds Management Corporation, Australia Post Super, and the Dexus Wholesale Property Fund. She has immense experience relevant to the topic today. She holds a Bachelor of Economics in the University of Tasmania, one of my prior universities, and is a Chartered Financial Analyst charter holder. In January 2019, Maria became a member of the Order of Australia for her service to business, finance, and to the community. Today, Maria will be talking to us about the key trends expected in the next 5 to 10 years in sustainable investing. She'll be explaining the necessary changes needed to be implemented by the industry, investment firms, and investment professionals. So thank you for taking the time to talk to us today, Maria. I'll hand over to Greg now for a couple of housekeeping matters before you commence your presentation. Thank you.
Thank you, Sue. Just a simple housekeeping matter, which I'm sure you're all becoming very accustomed to. You will note in the chat that the link to the Slido for this plenary session is up there. So if you will go to that link and enter the questions as Maria is presenting, I will then present these questions on your behalf to her at the end of her presentation. So thank you very much. Maria, over to you.
Okay, well, thank you all very much for that very warm welcome. I'm very pleased to be here and to be speaking with you about investment management industry and sustainability. So what I want to cover are some observations on what's been happening in the industry, in particular trends relating to sustainability. I want to discuss some contested topics and under-researched areas that would benefit from academic focus. So I do like a bit of controversy to spice things up. I have some data from a CFA Institute study on sustainability to share. And finally, I'll outline some specific actions for firms and for individuals. So as Susan mentioned, I've been in the investment management industry for 30 years in a range of different roles. And the thoughts and experiences that I want to share with you come from an industry practitioner's perspective, which I hope you find valuable. What I find valuable is collaboration between industry, academia and government, as we each bring different perspectives and strengths and can learn from each other. This should lead to better informed debate and decision making, and therefore better societal outcomes. And most of us, I've found, fundamentally want to make a difference, regardless of which sector we're actually working in. And so you know what to expect. I'll speak for around 35 minutes. I have some slides about halfway through and then open up for Q&A. The conference then heads into an industry panel discussion. The investment management industry is critical to the efficient functioning of capital markets and plays a pivotal role in society more generally. The incorporation of sustainability in investment management is a critical element in the industry's mission to serve society by improving long-term outcomes. The intersection of the COVID-19 pandemic, which has accelerated many changes that were already in flight, and sustainability in investment management has been very interesting to observe. COVID generally has, among other things, thrown a spotlight on inequality, access to healthcare and education, and casual labour. It's boosted online retailing, working from home, and the tech firms that enable that. In the investment industry, COVID has focused the mind on interconnectedness, systemic risk, and resilience, which from an industry standpoint fit hand in glove with the notions of investment stewardship and ESG. So rather than dropping down the list of priorities, or even off the agenda, as some expected, given the multitude of other things we've had to worry about, investment stewardship and ESG have very much remained top of mind. It's important to acknowledge that the foundations of sustainability are additive to foundational concepts of the profession. We're not throwing out traditional investment concepts, but rather using ESG considerations to develop deeper, more fully formed insights into security analysis and portfolio management. And interestingly, sustainability goes to the heart of the shareholder versus stakeholder debate, which historically has been a contested topic. But incorporating stewardship and ESG factors necessitates a shift away from a narrow view of pure financial considerations and how they might impact short-term shareholder returns, to a broader view of material, financial and non-financial factors and how they will impact all stakeholders over time. Risk and return outcomes for shareholders are critically important, but the impact on all stakeholders of a business's operations, their social licence to operate, are ultimately what drives returns for shareholders in the long term. And the super funds that you'll hear from in the panel session next are focused on generating sustainable long-term returns to members and therefore are motivated to invest in sustainable companies. Now let's look at some of the trends we've seen over the past 12 months. In terms of governance, my observation over 2020 was that board governance and decision-making shifted from being based on predetermined schedules and highly structured agendas to greater flexibility based on circumstance and need. A number of boards in 2020 were at times interacting weekly for a while, with conference calls and topics as required. Key challenges discussed were technology, digital transformation, disruption and cyber risk, and culture. The transition of teams to working from home, how to manage that and ensure employee wellbeing were critical. On the investment front, boards focused on returns, markets, portfolio liquidity, regulatory responses, valuation policies, and the economic outlook. Now, these are, of course, not new topics, but the situation demanded greater flexibility and business needed to operate in different ways. And of course, all of these things were done virtually. During 2020, senior executives, including CEOs, were hired without any face-to-face meetings. That would have been absolutely unheard of just 12 months ago. But businesses and their governance needed to be much more agile and responsive. And I think that's a common theme, whether you're running a local cafe that's shifted to takeaway, an investment manager or asset owner navigating markets, or a regulator trying to ensure system stability. I think these themes are likely to persist, and I reckon agility was one of the words of the year. But moving on to investment risk. Measurement of portfolio risk has always been somewhat vexed and evolving. What exactly are we trying to measure and what for? And risk has morphed from a traditional narrow focus on tracking error versus a benchmark to the probability of meeting client or investor objectives, including being able to meet liquidity needs. The early release scheme announced last year obviously changed the constraints and operating environment for super funds with respect to liquidity. But portfolio outcomes, so outcome-oriented investing or solutions across broader dimensions, have become a focus compared to tracking error against an imperfect or mechanically constructed benchmark. And sustainability risks are explicitly recognised as investment risks. And the investment industry has shifted from an awareness of sustainability influences on investment portfolios to an increasing desire to measure and manage ESG factors. So instead of thinking about investment stewardship and active ownership as something that might divert attention away from achieving the best financial outcomes for clients, it's now recognised as necessary to achieve the best financial outcomes for clients. Investment management firms serve clients and super funds serve members who tend to have long-term goals. Most assets under management are invested for retirement, so they have a long investment time horizon. And most industry practitioners see ESG factors as potentially material, especially in the long term. Therefore, investment management companies and asset owners, our super funds, are in a position of responsibility to advocate for the long-term sustainability of the companies they invest in order to meet these goals. And surprisingly, and at least interestingly, this notion around sustainability and ESG has become a contested political issue, particularly in the US. I have to say it's been a debate more so in political spheres than among industry practitioners who see it as an ordinary part of investment analysis and product positioning. But the debate about fiduciary duty and taking account of material non-financial factors in investment decision-making had pretty much been settled. It was certainly widely accepted by the industry in Australia at least 10 years ago or more, and in Europe, certainly before that, that fiduciaries had a responsibility to consider ESG risks. However, the world can change and it can change back, depending on the political climate. In June 2020, the Department of Labor in the US introduced a rule under the ERISA Act called Financial Factors in Selecting Plan Investments. It was known as the ESG Investing Rule. There was also a notice of proposed rulemaking called Fiduciary Duties Regarding Proxy Voting and Shareholder Rights. That was introduced in August 2020. Both of these are regarded as midnight rulemaking actions, given the pending US presidential election at that time. The original proposal stated that ERISA fiduciaries must evaluate investments and investment courses of action based solely on pecuniary factors. The rule was amended in October 2020 to say investment evaluation must include factors that a fiduciary prudently determines is expected to have a material impact. Now, of course, that sounds entirely reasonable, but really it was intended to narrow the range of considerations that can be taken into account in investment decision-making. And it added additional compliance, arguably for no benefit. It was, according to the SEC Commissioners Lee and Crenshaw, a solution looking for a problem. And I have to say, I'm reminded of the current debate we're having here in Australia right now about the Your Super, Your Future legislation, which also seems to be a solution looking for a problem and creating an unnecessary compliance burden. Regulation that sounds entirely reasonable, but with a political agenda. In the US, this final rule was made effective on the 21st of January 2021, and it had been enforced by selective audits of ESG options in 401k plans. According to Marg Franklin, the CEO of the CFA Institute, even this final watered down rule, I quote, is a disservice to fiduciary stewardship and contrary to investor protection. We then had the change in administration and in the US and in early March 2021, the Biden administration issued a non-enforcement policy of the rule pending a further review. Regardless, it's unfortunate to politicise sustainability and ESG when the industry had essentially self-regulated. Some investment firms and some super funds have chosen to be leaders in the sustainability and ESG arena. They see investment performance or reputational advantages in that. And others have chosen to not be leaders. And that's how it should be. Firm and product differentiation and positioning are potential sources of competitive advantage. Consumers make their choices, and that's how the market should work. What we've actually observed in markets are environmental and social costs being internalised onto a company's financials, driven by the dual market forces of investment outcomes and investor preferences. A practical example of this is AMP, where a social issue has had a dramatic impact on a company's worth, in fact, bearing on its very survival. I think the facts of the situation are largely established and well known. The promotion of an executive last year to CEO after he'd been found guilty of sexual harassment. It led to the resignation of the chair of the board and a director after collective investor pressure. It was deemed by investors that the harassment issue hadn't been taken seriously enough by the board, and the corporate culture was one that tolerated sexual harassment. The executive had suffered a financial penalty, but there was no apology, no termination, and in fact, a promotion to CEO. Numerous female executives subsequently left the company, and money was flowing out the door, following negative ratings from asset consultants. Hence the changes to the board, and as of last week, the CEO. AMP has suffered a significant fall in its share price and is the subject of takeover and buyout speculation that could spell the end of the AMP brand. So this is an example of collective investor action, market forces as expressed through investor preferences in relation to a social issue. So I reckon there are some La Trobe Business School case studies embedded in this AMP saga. And if not, I reckon even a few best-selling business management textbooks should be there. Turning to the E in ESG, the environment. There's been a surge in interest among institutional investors in measuring the carbon footprint of their portfolio and exploiting the investment opportunities stemming from the transition to a low or zero carbon economy. Climate transition is being viewed as an historic investment opportunity. There's much excitement. Lack of policy certainty, which has been cited in the past as a barrier to investment, seems to have waned as an obstacle, and businesses are no longer waiting for government action. Companies are signing up on what seems like a daily basis to the goal of net zero carbon emissions and investing in renewable energy opportunities. So there is demand for tools to measure climate risk and opportunity from an investor perspective. Measuring carbon footprint is relatively straightforward. There is hard data, but measuring other dimensions of ESG risks are more challenging. Waste management, the management of scarcity of natural resources and biodiversity are environmental examples of that. So the whole area of measuring the relevance and impact of ESG factors on risk-adjusted returns is one area that's ripe for academic research, and I would encourage anyone with an interest to pursue that topic. And again, it's not settled, it is a contested area. Some research I came across recently by Cornell and Damodaran, it was called Valuing ESG, Doing Good or Sounding Good. And from this work, the evidence is mixed and inconclusive. They say that, I quote, some studies find companies that score highly on the corporate social responsibility scale reward investors with greater risk-adjusted returns. But there is little evidence that socially responsible funds that invest in companies with higher scores earn excess returns. I actually don't think that's particularly surprising. It depends on what question you ask and what data you interrogate. But there's no question that more research would help improve our understanding. I'd now like to share with you some research undertaken by the CFA Institute as part of the Future of Finance initiative. So can we have the first slide, please? Thanks, Erica. Great. CFA is, actually, can we have the second slide? Thanks. The CFA Institute surveyed 7,000 investment industry stakeholders for this research. There were 4,400 investment clients, both retail and institutional investors, and 2,800 CFA Institute members, including ESG specialists and C-suite leaders. The surveys were conducted from October 2019 to August 2020. And the objective was to better understand the drivers and implications of the growing interest in sustainability in investment management. And as you can see, it was a global project, and there were some interesting regional differences in some of the detail. And even though there is some detail, I think it's important to recognise that we're looking for drivers and trends. And I would very much caution against implying a degree of precision in the results that simply doesn't exist. I think we can use it to inform our thinking, but not draw hard and fast conclusions. Erica, the next slide, please. Thank you. The research showed interest in ESG has increased over the 3 years to 2020, and that 85% of CFA Institute members surveyed take ESG factors into consideration in their investment decisions. That's up from 73% in 2017. It's unsurprising, I think, that governance ranks most highly in terms of focus. 77% of the respondents consider it, followed by environmental factors at 70% and social factors at 67%. I think we can speculate that it's easier to identify, measure and manage governance and environmental factors where there's hard data compared to social factors where there's more soft data. So it's much easier to take them into account. It's quite difficult to observe the appropriateness of a company's culture or the effectiveness of their sexual harassment or bullying policies. These are not easy to measure or assess, unless of course there's a spectacular blow up that ends up making headlines, such as the AMP situation, and which arguably they brought upon themselves. If Pahari hadn't been promoted, would we have ever had insight into that culture? And would AMP be in the situation it's in now? We will never know. But turning to the chart, we can see that 15% of members surveyed do not take any ESG factors into consideration in their investment decision-making. So we can speculate that they are quant managers or investment managers that invest in macro-type strategies where there's no easy line of sight to ESG factors. It's difficult to envisage any fundamental bottom-up investment approach that does not. And in my experience, fundamental analysts have always considered ESG factors. They may just not have recognised it or called it that. Next slide, please. What's really interesting to consider is what has been the motivation for investment firms to consider ESG. The two top reasons are that it helps to manage investment risk and/or my clients demand it. So to rephrase that, we can say it's driven by investment merit or it's a marketing and distribution strategy. Both are legitimate market drivers. In the Americas, responding to client demand was most often cited at 65% of firms, and that's up from 45% in just over the 3 years. So it was a weighting to marketing and distribution, or at least being sensitive to investor preferences. EMEA respondents, by comparison, were more likely to cite a fiduciary duty, a positive reputational impact for their firm, or a regulatory requirement. So a combination of investment merit, compliance, and marketing. In my own experience, when I joined an investment management company in 2006, the United Nations Principles of Responsible Investing, the UNPRI, was a new initiative for asset owners, asset managers, and other service providers in the investment industry. Signing the UNPRI was, or so I thought, low-hanging fruit. It would be an easy first project for me. Australian clients were particularly focused on ESG, along with the firm's European clients, and our competitors were all signing up. It was cheap. $10,000 was all it cost to sign up at that time. Anyway, convincing the executives, who were primarily based in the US, that this was a good idea was no easy task. The reservation was coming from the investment teams, not from the sales departments, who were supportive. But their concern was that it would change the way they made investment decisions and be a compliance burden. Long story short, the company signed the PRI. It didn't change the investment decision-making processes, which were predominantly fundamental bottom-up, but it has become a compliance task requiring resourcing. There's now an annual reporting requirement, as the PRI needed to make sure that investment companies weren't signing up just for the marketing benefit, but rather were actually doing what they said they would do in respect of the principles. So avoiding greenwashing by investment firms. So that's the motivation for investment firms. Some combination of investment merit, marketing glow, or investor demand and compliance. Let's consider the motivation for investors who are central in all of this. Can I have the next slide, please? Thanks. Investors were asked if their interest in ESG was driven by the desire to achieve higher risk-adjusted returns, or to express their personal values or have a positive impact on society or the environment, or both. Overwhelmingly, institutional investors said it was to improve risk-adjusted returns, which is very fortunate because that is their job and their responsibility, not to express personal preferences or moral judgments. Retail investors were more likely to want to express their values or have a positive impact, which, given it is their personal money, is their prerogative. Interestingly, younger retail investors were less likely to prioritise their values compared to older investors. And I have to say that's not my experience, and maybe an example of me trying to read too much into the data. My experience is reflected in the views of my 25-year-old son, Lachlan. He believes that incorporating sustainability in his super fund portfolio is a better alignment with his values and will produce better investment returns. He expects us as investment professionals to address sustainability issues as well as create his future works. So I'm slightly surprised at the age data in the survey, but I did warn you at the start not to imply a degree of precision that doesn't exist. I think we can have a break from the slides. Thanks, Erica. Thank you. So how do investment firms and investment professionals adapt given these trends and challenges? For investment management companies and asset owners, our super funds, the encouragement of transparency in corporate reporting, supporting standardised frameworks such as TCFD and SASB, and using stewardship through proxy voting and engagement to ensure that companies are mitigating risks and considering opportunities. Those things will make a difference. Data and measurement reduce the risk of greenwashing, while standardisation can reduce the cost of compliance for companies. Instead of responding to 20 different surveys, complete this one single template, much easier. And collective approaches to engagement through entities like ACSI and Regnan mean that asset owners can punch above their weight, as well as, again, reducing the cost of compliance or the cost of engagement activity for companies. The whole area of culture is becoming more important as a business driver. It's discussed around board tables and dinner tables. My children are just starting their careers, and I'm surprised how often they talk about the culture of the companies they're working for. When I was starting my career, I thought that only old people talked about culture. So it's clearly now a hot topic, and I think that's a good thing. But there is limited public disclosure of culture and no consensus on the right metrics. It's really an exercise in judgment, but it is being elevated in analysts' assessment of the companies they invest in and in asset consultants' assessments of investment management companies. And I note that frontier investment consultants have explicitly increased the processes and weightings of the assessment of culture. Frontier's culture principles are looking at the treatment of clients in terms of transparency and communications, the treatment of staff, including diversity, equity and inclusion, rectification of problems and errors, and evidence of systemic behavioural issues. At the board level, we risk being overly reliant on management's perspectives, which may present an overly optimistic picture. For quantification, we rely on employee opinion surveys. So I'm sure there's better work to be done here, and this will be definitely an evolving area. And finally, some practical tips for individuals, which is drawn from another CFA Institute report on investment professionals of the future. And apologies to my CFA colleagues who may be listening today, who've heard me speak about this before. But I thought we'd finish with a change of pace before question time and indulge in a little conversation about personal development and skills. So can I have the next chart, please? Thank you. So we know that the skills we need to be successful are changing, and we need to be adaptable. Lifelong learning and a growth mindset will be critical for career success in investment management or other careers. This CFA research grouped skills into 4 categories and considered the future demand of these skills from business leaders. From the top left, it's interesting that technical skills are ranked last. Only 14% of industry leaders rank them as their #1 priority. This surprised me. My view is that technical skills are the ticket to the game, and unless you have them, you won't make it onto a shortlist, let alone get an interview. So my advice is don't ever neglect technical skills and keep them current through continuing professional development. Soft skills. This skills category is ranked first by 16% of industry leaders, just slightly higher than technical skills. It includes creativity, empathy, and relationship and communication skills. And given that technology will automate many routine technical tasks, individuals will undertake higher value activities that require soft skills. Leadership skills, which include the ability to articulate a mission and a vision, instill an ethical culture, and crisis management, are ranked #1 by 21% of industry leaders. And finally, top ranked are T-shaped skills, which are the most valued types of skills overall, and are ranked #1 by nearly half of the industry leaders. T-shaped skills encompass the ability to connect across disciplines and businesses and to understand the broader organisational context of your work. So that's the horizontal, with the aptitude and specialist knowledge to go deep. People that have been most successful in the investment industry have T-shaped skills. They are good communicators and smart technically. They're quick to see the big picture, but don't shy away from the details. They are the talented portfolio managers who've started their own businesses and been able to sell as well. They probably don't call them T-shaped skills, but these are the skills that are in demand. And we can stop screen sharing again, thanks, Erica. From my own perspective and in my own current roles, I think about all of these skills categories and how I can do better. I think about my technical skills by staying up to date with investing trends, making sure that my knowledge is current so that I can add value and ask the right questions. My soft skills, I see that as how to best ask questions to constructively challenge. I perhaps should work on my self-awareness too. My leadership skills are modelling good behaviours and trying to improve my understanding of culture and workforce issues, getting out of the hard data, which is probably my comfortable space. And my T-shaped skills are knowing when to go broad and when to go deep. It's the classic governance problem, finding the right balance between governance and being a strategic thinker, but knowing when to ask about the details. So hopefully that gives you something to reflect upon in your own circumstances when the conference is over. It's always good to think about these things as development opportunities. If I can have Erica just for the last slide, just for a moment. Thank you. So finally, some credit where credit is due. The two research pieces from the CFA Institute that I've referred to are there on the screen. So the future of sustainability in investment management and the investment professional of the future. These are available online, so please feel free to access them, and then you can tell me if I have completely distorted their conclusions. Thank you very much, and I welcome your questions.
Thank you very much, Maria, on a very interesting, well, two talks actually. So I really do thank you. And the questions are coming in. So let me go to, this is in the order in which they've come. This is a nice general one to start with. What is the best way to incorporate sustainability in our investment portfolio? And what are the latest innovations in this space?
So I think that that really operates at two levels. I mean, in terms of doing sort of stock selection for an equity portfolio, you know, it's making sure that you're aware as an analyst of the broader risks and opportunities that's faced by a company. So thinking about its supply chain, what are the risks there? So modern slavery has obviously been something that people have been very focused on, and particularly looking at their supply chains in that area. So, I mean, I think generally it's nothing that is in fact new. It's something that a good analyst has always done, but we probably just didn't necessarily kind of call it ESG analysis. We've always looked at the composition and credibility of a board, for example. But I think, you know, we're now explicitly calling that kind of part of the G in ESG. In terms of the latest innovations, I mean, I think we're, as I said in my talk, there is hard data in some areas, but only soft data in other areas. We know that the materiality of social factors is increasing, and AMP was an example of that, but that involves a lot of soft data. So we need to continue, I think, to develop tools in that particular regard.
Thank you. And the next question, a PhD symposium paper that we listened to yesterday suggested that CSR ESG information is a potential source of information asymmetry, i.e. analysts and investors have difficulty in assessing it. And it is also a source of share mispricing. Do you have a view about this?
Well, I'm an active manager from way back, and I know that always makes me feel slightly uncomfortable in an academic environment, because I know that academics generally tend to favour passive approaches to investing. But as someone who is a supporter of active investment approaches, I see information asymmetry as an opportunity, and you know, that's if there is, I guess, and it's what makes a market. You know, if we all agreed on the valuation of things, or how important something was to, you know, to something or other else, then there wouldn't be there would just be a consensus view. There wouldn't be trading. There wouldn't be opportunities to take advantage of mispricing. So I very much see that as an opportunity for active management. And one of the, I think one of the other outcomes of the COVID pandemic is that it has, I think, tended to, well, as a result of what's happened there's greater dispersion and greater, I guess, well, to use the academic expression, greater information asymmetry. And hence much more opportunity for active managers. And what I'm finding with some of the boards that I'm on that entail investment governance is that we are in fact shifting to take advantage more of active approaches to managing the portfolio, as opposed to passively following a benchmark.
Thank you. Terry Walters asking, the Future Fund is seen by many as a bellwether. Can you see signals from their investments that ESG issues are of increasing significance to them?
I'm not sure that I know quite enough about the Future Fund to give a good answer there. I think that we can see that the industry generally is taking, providing much greater focus on ESG issues, and certainly talking about that. But I'm sorry, Terry, I can't specifically speak to the Future Fund.
Okay, and Ellie is commending you, as she should, on a marvellous presentation, and asks, as researchers, we need to observe and measure economic impact of events and transactions. I'm interested in what we may call scandals, as suggested. When does an event become a scandal?
Yeah, I tend to, I mean, that's a great question. Thanks, Ellie. I try to be like objective and generally try to use, I guess, language that's objective and not too emotive. I think you can be passionate about the industry that you're in and passionate about topics without necessarily being overly emotive. And scandal, I think, does conjure up a certain amount of emotion. I guess to reframe the question, I think an event becomes, significant or market changing when it's something that is, new to the table, that it's new information. Who knew that we should have been asking questions about AMP's corporate culture? I certainly, didn't know that was an issue. I think it became an issue because of what happened, and then we saw, many of their investment professionals, leave the company as a result. So, that was obviously that was something that did, I think, become something of a scandal.
Terrific. Now, a couple more questions from Anonymous. How do we consolidate managers' survey responses with our expectations on ESG? Using the automotive industry as an example, Manager A considers reducing CO2 emissions, while Manager B considers eliminating CO2 emissions by using alternative energy. And I think the next is a follow-on. I think it may have preemptively pushed the return button. Both managers will claim they have considered the E dimension in answering your survey. However, only the latter may have a significant impact on E. See Bill Gates on how to avoid a climate disaster.
So, again, I see that as being, that's part of the market. People should have different approaches, take different approaches. There's no one way to skin a cat. And that's, I think, a fundamental element of ESG, is that there's not a right way or a wrong way. You can invest in a tobacco company if you really want to, even if you're using an ESG approach, as long as you're taking into account the risk of, for example, litigation or compensation. So there's no sort of right or wrong way. It's not black and white, and different analysts and different managers will put different weights and have different approaches, and that's very much how it should be. In terms of products, if people, firms have, and one of the continuing arguments we have is ESG an investment approach, a mainstream part of an investment process, or is it a product? Is it something that excludes tobacco or CO2? Well, it can be both of those things. I think I was very much on the fact that it needed to be a mainstream part of an investment process, but I have been convinced by my colleagues that there is a role for ESG options where people want to, or super fund members or investors want to express a particular view by investing in a particular fund. But I do think it's very important that that institutional trustees are careful to be true to the word of the fiduciary duty of taking an investment-oriented approach rather than trying to express their personal views or preferences. That's up to individuals to make those choices. That's not up to institutional trustees.
Na is asking, super funds are increasingly internalising funds management. Do you expect that they will be able to do a better job in ESG analysis and stewardship than their external asset managers? And just
thanks, Na. Thank you for your question. And Na probably knows that the internalisation of funds management is one of my pet topics, actually. So I don't think they'll necessarily do a better job in ESG and stewardship. I think that the approach that we're seeing are collective approaches. So through ACSI, which is the Australian Council for Superannuation Investors, are acting for a range of different super funds. In fact, they're owned by the super funds, and Regnan being another private sector entity that's also involved in company in ESG analysis and company engagement. So I think it's about there are different ways to approach that, but I'm strongly supportive of collective approaches as a way of increasing leverage and getting more effective outcomes.
The next question is, the finance industry is embracing ESG in advance of government policy, as you stated. Is there a need to develop advocacy and policy development skills across the sector to support policy for clarity and stability for institutional and retail investors?
We have a lot of advocacy. We have a lot of policy development. We have a number, so in addition to ACSI, which I've spoken about, we have a range of different industry associations, trustee organisations, so the Australian Institute of Superannuation Trustees, we have the Financial Services Council, we have industry super funds, ISA, Industry Super Australia. So we do have, I think, pretty well developed advocacy and policy skills embedded in those entities, not necessarily in individual firms, but operating more collectively as lobbyists and as building policy muscle. Of course, many of them are operating from a situation of trying to advance a particular sectoral position. And of course, you know, that makes it very difficult to government, because the government has lots of people, you know, talking at it, advocating for different positions. So I think the more unity we can get, the better.
With increased focus on ESG and sustainability, how much do you think climate risk, physical, transition and regulatory, is priced into current valuations?
Wow, that's a great question for
Have a go with that one.
Perhaps not a fantastic question for me. I mean, we have the increasing awareness. You know, we're talking about that a lot. So one would think that it is, you know, if it's known and if it's talked about, one would think that it's priced. I think that one of the areas that I didn't speak about was the whole notion of engagement versus divestment. And I think it's fair to say that historically, the investment industry has very much wanted to emphasise engagement as a way of getting change. But I think within just the last 12 months, there's been a little bit of a shift towards divestment, and some funds see the risk of stranded assets, particularly in the area of climate risk and coal. And again, that's a judgment, but definitely I think the environment has shifted from just one of, you know, wanting to engage and improve outcomes, thinking like a universal owner, to the notion of perhaps divestment is the way to go. And just in terms of that, I would like to call out the work of Dr. Bronwyn King in the area of tobacco, and her organisation that she established, tobacco-free portfolios, where many funds, many institutional investors have in fact divested of tobacco exposure.
Terry's got a follow-up question to his future fund question. Do you think investors are sufficiently well informed about the portfolio investments their funds have made? And I think there is not necessarily referring to the future fund. But...
Yeah, right. So we have, so I would say that there's a lot of information, there is a lot of information available to investors about what is in their portfolio. We've had portfolio holdings disclosure regulation that's has been imposed, where funds, I just trying to think, I was involved in the debates at the time, and I think we landed where the top holdings are required to be disclosed. Of course, what we have to do is, you know, try to be as transparent as possible. But of course, with that comes cost. And the cost in terms of compliance, in terms of getting that information out there. But also, I think that, you know, there is a potential cost in complete transparency around disclosure in terms of IP, and that funds don't necessarily, not so much with a listed share portfolio, but with unlisted infrastructure investments or other hedge fund investments, that there is, you know, potentially IP to protect. And hence my understanding, and I'm trying to remember where we landed, but I think that there is a quarterly lag involved in terms of when those disclosures need to be made. So just to put a bit of a gap between what the portfolio, you know, may be, and prevent any kind of gaming or trading against it.
And Benita's asking, what are your thoughts on the non-standard or variation approach of definitions that are applied on ESG across funds?
So the whole area of jargon and taxonomy is very vexed. And what we often find is that you can have ESG specialists talking at cross purposes. It can be quite a misunderstood area. Some people equate ESG with ethical investing, which I see it as, you know, maybe they're cousins, but they're certainly not the same. So I think that around that area of definitions, it's definitely a problem. In Australia, I think we're reasonable at speaking kind of the same language and using similar definitions. But what I find in my conversations at CFA and in different and in other global markets, that you know, what something means here may mean something else in another jurisdiction. So I think that, and I believe the European Union are doing some work around that, but I'm not over the detail. But just to create some standardisation in terms of the language we're using would be very helpful.
And Petco is commending you on your talk and thanking you. What is the place of academic research, and how can we help the finance industry now and in the near future?
Well, we certainly need it. We always need academic research, and it definitely, it can, I think, raise the level of evidence that we're using to make investment decisions and also policy decisions. So I would say get involved. I'm a great believer in collaboration between academia and the industry, and we need more forums like the one we're having today, so that people can exchange ideas. I have tried to flag throughout my presentation some areas that I thought would specifically benefit from more academic research, and strip out, I think, some of the emotion and some of the politics from the conversations that we seem to be having.
Well, and we've just ticked over to 1 p.m. and so I think it's a very opportune time to thank you, Maria, on a wonderful presentation, very thought-provoking. You've certainly identified a lot of work that we need to do as academics, and indeed work, I think it's developing those T-shaped skills with industry to be able to better make more informed and better, more sustainable investments. So you've certainly hit on some very, very important notes. Sue, would you like to say anything?
Sure. Yeah, thanks, Greg, and thanks, Maria. That's been a fantastic presentation, and I think that the way in which you've tried to separate out some of the normative questions from the opportunities for doing further research are really important, and demonstrating the capacity to bring this data together so that people can maintain their sense of where the industry is up to and can actually delve further into the opportunities around ESG. So thank you very much for your presentation today. I know you're out of time, so I will stop there. Thanks, Greg.
Thank you.
Thank you, Sue. And thank you, everybody, for joining us for this wonderful presentation, and very important, on a very important topic. So Maria, thank you, and thanks, Sue. Over to you, Bala. Oh, you need to unmute, Bala.
Thank you, Maria, for giving us an outstanding talk on the future trend on the sustainable investment.